You've been told that you need a secret formula or a massive inheritance to start investing. That is a lie. In 2026, if you're starting at $0, you don't need a broker, you need a roadmap. Today, I'm giving you the 5-step blueprint to go from zero to your first $100,000 and eventually your first million. The first 4 steps build the foundations, but the 5th step, that's what actually automates your growth. If you miss that, you're not building wealth, you're just working a second job. So, let's get started. Phase 1. The reality check. Here's what nobody tells you when you're starting from zero. Your biggest enemy isn't lack of knowledge or opportunity, it's the weight you're already carrying that you can't see. I'm talking about debt, and specifically high-interest consumer debt. There's this dangerous narrative floating around that you can invest your way out of debt. People ask whether they should put money into the market while carrying credit card balances, as if both can happen simultaneously. This is financial fantasy. The math doesn't support it, and more importantly, the psychology destroys you. Let me paint the real picture. If you're carrying $8,000 on a credit card at 22% interest and making minimum payments, you're not treading water, you're drowning in slow motion. That interest compounds against you every single month. Meanwhile, even if you somehow picked perfect investments and earned 12% annually, which is unrealistic for most people, you're still losing money on the spread. But it's worse than just the math. Debt creates a scarcity mindset that infects every financial decision you make. When you owe money, you can't take the career risks that lead to bigger opportunities. You can't negotiate from a position of strength. You can't say no to things that don't serve you because you need every paycheck just to service the debt. So, here's my first move if I'm starting from zero in 2026. I audit every dollar I owe. Not just credit cards, but personal loans, buy now, pay later schemes, anything with an interest rate above 7%. I write it all down, organized by interest rate from highest to lowest. This is called the debt avalanche method, and it's non-negotiable. Every spare dollar goes to that highest rate debt, not split across multiple debts, not the one with the smallest balance to feel good about closing an account, the highest rate, period. Once that's eliminated, the entire payment amount rolls to the next highest rate debt. This creates a snowball effect, but based on mathematical efficiency rather than emotional satisfaction. I know this part isn't exciting. You came here to learn about investing, not debt payoff. But here's why this matters. Paying off a 20% credit card is functionally identical to earning a guaranteed 20% return on an investment. Show me where you can get a guaranteed 20% return in the stock market without massive risk. You can't. It doesn't exist. Clearing this debt isn't just about the numbers. It's a psychological unlock. Once you're debt-free, you can start playing offense instead of defense, and that mindset shift is worth more than any investment strategy I could teach you. Phase 2. Building your financial moat. Once the high-interest debt is gone, most people immediately want to jump into investing. This is a critical mistake that I see constantly, and it ruins more portfolios than market crashes ever do. Here's what happens. You finally have some money freed up. You open a brokerage account, you buy some index funds, you feel like you're finally making progress. Then your car needs a $1,500 repair, or you need emergency dental work, or a family member needs help. Life happens, and it always happens at the worst possible time. If all your money is in the market and you need cash immediately, you have 2 terrible options. Either you sell your investments, potentially at a loss if the market is down, or you go back into debt. Both options destroy your financial momentum. This is why before I invest a single dollar, I build what I call a cash fortress. Not a cash position, not a little cushion, a fortress. This is money that sits in a high-yield savings account, completely liquid, earning somewhere around 4 to 5% in the current environment. The amount matters. I calculate my absolute bare minimum survival expenses, not my comfortable lifestyle, but the floor. What does it cost me to keep a roof over my head, food on the table, basic utilities running, and transportation to work? I multiply that number by 4. That's my target. Why 4 months instead of the traditional 3 to 6? Because in 2026, job transitions take longer than they used to. The hiring process is slower, and if you're laid off or need to make a career change, you need runway. 4 months gives you breathing room without it feeling like it's impossible to achieve. This cash fortress serves multiple functions. Obviously, it's there for emergencies, but more importantly, it's psychological armor. When you have 4 months of expenses sitting in the bank, you walk into your boss's office differently. You negotiate differently. You make career decisions based on what's best for your growth, not what you're desperate to accept. And here's the part that most financial advice misses. This cash position prevents emotional investing. The biggest destroyer of wealth isn't market crashes, it's panic selling during crashes or FOMO buying during bubbles. When you have a proper cash buffer, you can watch the market drop 30% and see opportunity instead of catastrophe. That emotional control is worth more than the potential returns you're missing by keeping cash on the sidelines. I fund this fortress through automation. Every payday, before I see the money, a portion goes directly into the high-yield savings account. I don't trust willpower. Willpower is a finite resource that gets depleted by stress, fatigue, and life's daily decisions. Automation removes the decision entirely. Once this fortress is fully funded, I mentally lock it away. It's not for vacations, it's not for a new laptop because mine is getting slow, it's for true emergencies only. And only after it's complete do I even think about the stock market.
Phase 3. The tax code advantage. Now we're ready to invest. But here's where most people make their second critical mistake. They open a standard brokerage account because it's the default option on most platforms, and they start buying. What they don't realize is they just volunteered to give away potentially hundreds of thousands of dollars over their lifetime. The tax code is essentially a rule book for wealth building. The government created specific incentives to encourage certain behaviors, primarily saving for retirement. Ignoring these incentives is expensive, and I mean mathematically provably expensive. Let me give you a concrete example. Suppose you invest $7,000 today in a taxable brokerage account. Over 30 years, assuming a 10% average annual return, that grows to about $122,000. When you withdraw that money, you'll pay capital gains tax on the $115,000 gain. At a 15% rate, that's $17,250 going to the IRS. Your net is $104,750. Now suppose you put that same $7,000 in a Roth IRA instead. Same growth, same time period, same $122,000 end value. But when you withdraw it in retirement, you pay zero taxes. You keep the full $122,000. That $17,250 difference isn't because you picked better investments. It's purely because of account selection. And if your employer offers a 401k match, this becomes even more obvious. A 50% match on your contributions is literally a guaranteed 50% return on day one. You cannot find that return anywhere else in the financial universe. It's free money, and turning it down is financial malpractice. So here's my exact protocol for tax-advantaged investing. First, I contribute to my 401k up to the employer match. This is the highest return I'll ever get, guaranteed. Second, I max out a Roth IRA. For 2026, the contribution limit is likely around $7,500 for people under 50, though you should verify the exact number. Third, if I have a high-deductible health plan, I max out a health savings account. This is actually triple tax-advantaged. Contributions are tax-deductible, growth is tax-free, and withdrawals for medical expenses are tax-free. It's the single best tax-advantaged account available, and most people completely ignore it. Fourth, I go back to the 401k and fill it up as much as possible. Only after all these tax-advantaged buckets are completely full do I put money into a taxable brokerage account. This sequencing creates a tax shield that accelerates your wealth building significantly. We're not talking about small differences. Over a 30-40-year career, proper use of tax-advantaged accounts can mean the difference between a comfortable retirement and a wealthy one.
Phase 4. The investment strategy.
Now we finally get to the question everyone asks first but should actually ask fourth. What do I actually invest in? Here's where I'm going to save you years of mistakes. When I started investing, I thought I needed to find the next Amazon. I spent hours researching individual companies, reading analyst reports, watching CNBC, trying to develop an edge. It was exhausting, stressful, and ultimately counterproductive. The data is clear and brutal. Over any 15-year period, roughly 90% of professional fund managers failed to beat the S&P 500. These are people with teams of analysts, Bloomberg terminals, direct access to company executives, and decades of experience. If they can't consistently beat the market, what chance do I have doing it in my spare time while working a full-time job? The answer is essentially zero. And that's fine, because I don't need to beat the market. I just need to match it. If I can get the market return consistently over 30 years, I will become wealthy. It's not exciting, but it's mathematically certain. This is where index funds and ETFs come in. When you buy a total market index fund, you're buying a small piece of thousands of companies simultaneously. You're diversified across sectors, company sizes, and business models. When one company fails, it barely moves your portfolio. When one company succeeds dramatically, you own it. The specific funds matter less than most people think, as long as you follow a few basic rules. First, keep expense ratios below 0.10%. Anything higher is just giving away money for no additional benefit. Second, stick with broad market exposure. Total U.S. stock market or S&P 500 funds for domestic exposure, total international for global diversification. Here's my exact allocation starting from zero. I put 90% of my investable assets into a core portfolio of low-cost index funds, something like 70% total U.S. stock market, 20% total international stock market, and 10% bonds to slightly dampen volatility. This is the boring money that will actually make me wealthy. Then I take the remaining 10% and I give myself permission to be dumb with it. This is my speculation bucket. If I want to buy individual stocks, crypto, or whatever else catches my attention, I do it here. If it goes to zero, my financial life is completely fine. If it goes up 10x, great, but I'm not counting on it. This 90-10 split serves a crucial psychological function. It scratches the itch to gamble without blowing up the plan. Most people can't sustain a completely boring portfolio. They need some excitement, some feeling that they're actively doing something. By giving myself 10% to play with, I satisfy that need while protecting the vast majority of my wealth. The hardest part of this strategy isn't implementing it, it's sticking with it when it feels wrong. And it will feel wrong, frequently. When tech stocks are soaring and your boring index fund is just going up steadily, you'll feel like you're missing out. When your cousin makes 50% on some stock tip, you'll question the approach. This is where most people fail. You have to accept that good investing should feel boring. If it's exciting, you're probably gambling. The market rewards patience and punishes activity. Every time you trade, you're incurring costs, triggering potential taxes, and likely making an emotional decision rather than a rational one.
Phase 5. The Income Accelerator. Everything I've described so far will work. If you follow this blueprint, eliminate debt, build a cash buffer, maximize tax-advantaged accounts, invest in boring index funds, and stay consistent, you will build wealth. Mathematics guarantees it. But there's one variable that can accelerate everything dramatically, and most people completely ignore it: your income. You can only cut expenses so far. There's a floor to spending that's determined by your basic cost of living, but there's no ceiling on earning. And yet, most financial advice focuses almost exclusively on the spending side. Cut the lattes, cancel the subscriptions, meal prep, drive an older car. This is defense. Defense prevents you from losing, but offense wins games. If I'm really starting from zero, I need to think about how to increase my earnings, not just optimize my budget. Here's the math that changed my perspective.
A side hustle driving for a rideshare app might net you $15 to $20 per hour after expenses. If you work 10 hours a week, that's an extra $800 a month. Not nothing, but it's also capped. You stop driving, you stop earning. Now compare that to investing time in developing a high-value skill that can increase your primary salary by $15,000 a year. That's $1,250 extra per month recurring without working additional hours. Plus, it counts toward 401k matches, Social Security credits, and serves as the base for future raises. The math heavily favors leveling up your primary income over linear side hustles. The challenge is that skill development is hard. It requires sustained effort over months or years with no immediate payoff. It means being a beginner again, which is uncomfortable when you're competent in your current role. But this discomfort is precisely why it works. If it were easy, everyone would do it, and the pay premium would disappear. The fact that it's hard is what creates the opportunity. So here's my final protocol. I audit my current role and identify the one skill that, if I mastered it, would make me invaluable. Maybe it's public speaking. Maybe it's advanced Excel or data analysis. Maybe it's project management or technical writing. Whatever it is, I dedicate 1 hour per day to developing it. 1 hour sounds small, but it compounds. Over a year, that's 365 hours of deliberate practice. That's enough to go from beginner to competent in most skills, and competent is often enough to unlock the next level in your career. I use free resources wherever possible. YouTube, library books, free online courses. The knowledge is available. What's rare is the sustained commitment to actually learn it. After 6 months of consistent skill development, I use that new leverage. I ask for a raise backed by the additional value I'm now providing, or I apply for higher-level roles at other companies, or I start positioning myself for a promotion. A 15% increase on a $60,000 salary is $9,000 per year. That's an extra $750 a month that flows directly into my investment strategy. It fills the tax-advantaged accounts faster, builds the cash fortress quicker, and dramatically accelerates the timeline to financial independence. So if I woke up in 2026 with nothing, here's the exact sequence. First, I eliminate all high-interest debt using the avalanche method, attacking the highest rates first regardless of balance size. Second, I build a 4-month cash fortress in a high-yield savings account, funded through automated transfers every payday. Third, I open tax-advantaged accounts in this specific order: 401k to the match, Roth IRA to the max, HSA if available, then back to 401k. Fourth, I invest 90% in boring broad market index funds with expense ratios under 0.10%, keeping 10% for speculation if I need the psychological relief. And fifth, I commit 1 hour per day to developing a high-value skill that can increase my primary income, then leverage that skill for raises or better opportunities every 6 to 12 months. This isn't a get-rich-quick scheme, it's a get-wealthy-for-certain scheme. The timeline depends on your starting point and income, but the math works regardless. Someone earning $40,000 will move slower than someone earning $80,000, but both will get there if they stay consistent. The beauty of this approach is that it's completely within your control. You don't need the market to cooperate, you don't need to pick winning stocks, you don't need perfect timing. You just need to execute the system and let time work in your favor. Personal finance is personal, and maybe you have a different perspective on parts of this strategy. Maybe you prefer different debt payoff methods or different asset allocations. That's fine. The specific details matter less than the underlying principles. Eliminate high-interest debt, build liquidity before investing, maximize tax advantages, diversify broadly, and increase your income over time. If you found value in this breakdown, I'd love to hear your thoughts. What would you do differently? What part of this strategy resonates most with your situation? Drop a comment and let's discuss. And if this helped you see a clearer path forward, consider subscribing. I break down complex financial topics like this regularly, and I'd love to have you along for the journey. The biggest mistake I see people make isn't in the strategy itself, it's in the starting. They wait for the perfect moment, the perfect amount of money, the perfect market conditions. But here's what I've learned. There is no perfect moment. The best time to start was 10 years ago. The second best time is right now. In 2026, you have advantages that previous generations didn't have. Access to low-cost index funds was a luxury 20 years ago. Now it's standard. High-yield savings accounts that actually pay interest are widely available. Free educational content about investing is everywhere. The tools exist. The only question is whether you'll use them. I can't promise you'll be a millionaire in 5 years. Anyone who promises that is selling you something. But I can tell you with certainty that if you follow this blueprint consistently over 20 or 30 years, you will build substantial wealth, not because of some trick or secret, but because of simple mathematics applied consistently over time. The compound interest formula doesn't care about your background, your current situation, or your past mistakes. It only cares about 3 variables: how much you invest, what return you earn, and how long you stay invested. You control the first and third variable completely. The second variable takes care of itself if you choose broad market exposure. Starting from zero in 2026 isn't a disadvantage. In many ways, it's an advantage because you get to build the right foundation from day one. You won't have to unwind bad habits or costly mistakes. You can start with the optimal strategy and let time work its magic. So take the first step. If you're in debt, make a plan to eliminate it. If you don't have a cash buffer, start building one today, even if it's just $50 this week. If you haven't opened a Roth IRA, do it this month. Small actions compound just like investments do. Thanks for your time, and I'll see you in the next one.